The way that I constructed the panels for this event is I wanted to have people on these panels that I follow and deeply respect and have been following them for a while and know a lot of what they have to say when it comes to the microcap space, and it's really quite insightful. So with that, because I don't want to cut too much into our time, firstly, I'd like to introduce our moderator, Mr. Brian Balbirnie from Issuer Direct Corp. Let's give him a nice round of applause. I'd also like to introduce Mr. Brent Cook. He is the editor and geologist of Exploration Insights. In fact, my very first financial conference I've ever been to, I watched Brent speak at it, and I've been a follower ever since then. So, Brent, thank you again for coming. Wasn't that long? I mean, look, I'm still 28, so that was like only 5 years ago. But still, I've been a follower ever since. And Maj Soueidan, who was also here speaking on this panel from geoinvesting.com. I've been a follower of Maj's for quite some time. We did a great interview for our podcast, actually two. And I'm just very thankful that he came to the event today. So thank you very much for joining us today.
Thanks for having me.
And Mr. Paul Andreola, thank you again for you as well for joining us today on this panel. He is the editor of Small Cap Discoveries. And again, I've been following Paul for quite some time, and really all three of them have some great newsletters out there that I really highly recommend everybody take a look at and consider. And I'm just thank you, Paul, for joining us today. And with that, Brian, the floor is yours.
Thank you, sir. Good afternoon, everybody. Bobby did a good job of introducing each one of us, so I thought that what I would do is give each one of the gentlemen on the panel an opportunity to kind of talk a little bit about themselves and their background. Maybe, Paul, if we could start with you, sir.
Sure. Everybody can hear me okay? Paul Andreola. I'm based in Vancouver, Canada. I got my education in, of all things, construction management, so that set me up perfectly for this investment world. I've been a broker. I've started two companies, tech companies, one that was quite successful, one that wasn't quite so successful, actually a miserable failure, which I think was very important in my learning process. And really what I am is I'm a full-time investor. We, along with my partner Brent and Mackie, have taken our experience and try to use as much common sense. We work specifically in the Canadian markets, the junior or the microcap markets. We don't do anything on the resource side. That's something where we let guys like Brent take care of that. And we follow a rigorous strategy that we found as private investors has worked for us for years and years. And now we have a newsletter that we hope can help other people sort of see what we do.
Good, thanks, Paul. Maj.
Hello. Thanks, Brian. My name is Maj Soueidan. I'm a co-founder of geoinvesting.com. Was founded in 2007. It's a website that brings research to investors who follow microcap companies. My background, I started my first kind of exposure to the stock market was with my dad. I used to watch the nightly business report, which was a stock wrap-up program at the end of every evening. Later on, he gave me my first book to read while I was in college called One Up on Wall Street. Really, I actually entered college to be an attorney after I read that book. I don't think my dad's too happy about this, but I decided to switch to the finance area and become a stock guy. And during college, I worked several jobs and saved some money up, and I started investing in college. Out of college in 92, I worked at Vanguard for a couple of years, part-time, while trading stocks or investing in stocks, writing a small newsletter for a little bit and learning the ropes a little bit, and it became a full-time investor in 94, and then I decided to launch geoinvesting in 2007, and like Paul, I've had a lot of success, a lot of failure though too, and learning along the way how to invest, and we try to bring those lessons to our community of investors.
Good points. Brent.
Right, Brent Cook. I'm a geologist, economic geologist. I've been doing this since '78. I've worked in over 60 countries now, on projects from gold, copper, lead, zinc, silver, uranium, etc., from very early stage discovery, conceptual type targets through to bankable feasibility studies, the privatization of ZCCM in Zambia and BRG, or the Vale in Brazil. I worked for mostly as a consultant to companies up until about 1997, at which point, I'll tell a story here. In 96, I was working in the Amazon jungle on a project that didn't stand a chance in hell of being worth anything at all. It was a horrible place, rained all day, a bunch of local garimperos and prostitutes was always around. And the company that owned this flew in with their board members and a couple of investors, had a quick tour of it, got the story, and left me standing there in the rain, went to Manaus for the opera, and the stock proceeded to triple. And at that point, I thought, I'm doing something wrong here, because there's nothing here. So anyway, I joined up with a fellow named Rick Rule, who, if you know the resource industry, he is the #1 broker in the United States. And following on the idea of losing money is the best way to learn, he gave me a $250,000 line of credit that I could invest in anything I wanted and keep the profit after a bit of interest. Within a year and a half, I was 90 grand in the hole. So that's sort of how I got into the junior resource side, putting the rocks and the money part together, and we've done pretty well since then.
Turning rocks into money.
Turning rocks into money.
So maybe we get an overview of each of your newsletters. And one of the things that we were talking about earlier, guys, was that as all of us as investors look at Bloomberg and FactSet and fundamental data on free websites and subscription platforms, and to a degree you get social media influences there, and yet SEC filings, it's information overload. Maybe you don't know where to get the right insight on specific companies. So I wonder, as you guys talk about your newsletters and what you're doing, maybe we kind of think about that as a focal point. Is that why would somebody want to subscribe to the newsletter compared to maybe looking out at some of these other fundamental platforms to get different data sets?
Me.
Right, sir.
Right. The letter Exploration Insights. There's two of us there, myself and Joe Mazumdar. Joe joined up last year. He's about 43 years old. He's got a degree in geology. He's got a master's from James Cook University in Australia and a minerals economic degree from the Colorado School of Mines. He's worked for a lot of the major companies: Rio Tinto, BHP, MIM, Newmont Mining, and he was an analyst as well for a couple of firms up there, and then he joined up with me. Our letter goes into basically what we are buying and selling and seeing in the junior exploration sector. We don't get paid by any company to say anything. We occasionally get offered not to say anything. And so the letter is just about that, what we're doing with our money. It comes out every Sunday plus alerts, and we charge, I'll go into all this, we charge $140 a month on a monthly basis, and that gives you access to everything we've ever written, bought, sold, etc.
Good. Maj.
Yeah, well, that's a particularly good question because, we deal with microcaps, and, when you talk about the resources available to a MicroCap investor to do the research, if you look, I've talked about Bloomberg or Reuters and Facts and all of these. Now there's a level of size where they just don't provide the best information, and I actually had a Reuters sales guy come into our office about 3 months ago to pitch us to use one of their new portals, and they're like, well, why are you even following microcaps? So it sets a tone for why. So this is a situation that, as an investor, I've experienced this for many, many years, and so I think that microcap investors have to work a little harder to get what they want to get in the information. So I figured that's what geo-investing does. We have 15 people working at the firm, I think right now as a count. We're turning over rocks, reading SEC filings, conference call transcripts, interviewing management companies, and we just do it the old-fashioned way. We're not using algorithms. And there's something to be said to that. And it's just, we basically, what I like to say is that we're a team. You know, it's like having, you know, an investment bank working for you, without the conflict of interest at a retail price.
So is it fair to say you're sifting through all the data for them, right?
We're doing
some of that work for
everything
them.
that, you know, a individual investor or even institutional investor would take some time. We just save time, and we bring through real quality ideas.
So what's the value driver there? Is it growth? What are you looking for?
You look, you know, well, there's a value. I mean, the value driver to our team is that, you know, we define 4 pillars, and we try to bring to our community. And after 10 years, we've kind of like been able to define these pillars over time. You know, and it's quality of research, trust. We're very, we disclose everything we do. We're very early in our due diligence process. We let the investor follow that from the very beginning, whether we're buying or not doing anything. We just let them know. So there's, and then there's the team we have, the breadth of team. We have a very diverse team of anywhere from finance professionals to non-finance professionals to everyday investors that we've taught over time. And then our return's been pretty good, you know. So it's and the value driver that we look for in companies now. I think that was your kind of asking me a little bit, was that, you know, we're basically growth plus value investors, plus, you know, special situation. We throw it out there, and we're looking for catalysts and, you know, and inflection points, as we all are, but you know, we're looking for short-term and long-term type of catalysts, and. One of the things we love to do is we're looking for catalysts that are going to basically improve the growth profile or risk profile of a company going forward, and it's real rewarding to look at these catalysts and, you know, find them, and you can do that in MicroCaps. And the harder it is to find these catalysts, the more we like it, because that means it's harder for, you know, the average investor to go find them, and that's an opportunity we exploit and we bring to our readership.
Yep, appreciate that. Paul, how about yourself?
Well, like I said earlier, we everything we do is driven by the fact that we're investors first. So we put a significant amount of our own money at stake. So we do an incredible amount of due diligence in the companies we invest in. Our approach is a true bottoms up. We take raw data, and in our world, the Canadian market, it's CDR. So we start with our fundamental data on CDR. We don't use any sort of screening software, because we find that software, every now and then you're going to get one that's going to fall through the cracks, and those are the ones you want, right? So we're looking for significant mispricing to establish a watch list. And then once we've got our watch list, then we go into a different level of due diligence where the average person or subscriber doesn't have access to that information. I spent 15 years as a broker, for example, so I know how the system, the investment brokerage system works. I know how the research market works. I know how institutional investors work. So we look for indications or signals that the average person, in some cases, doesn't know about or doesn't have access to. So there's a whole set of layers of due diligence that we do that we hope help our subscribers to make that final investment decision. We are fundamentally driven, like I said, bottoms up. We look for specific criteria that, through our experience over time, I've been at this for 30 years, we have a sense of what tends to work on a consistent basis. So we're looking for, we're GARP investors, growth at a reasonable price. One of the advantages we have is because in the microcap space, especially in Canada, I think in the US you guys have a little bit more research that reaches down to the nano caps. But in Canada there's a void. So we're one of a few groups that are actually looking in that space. So because there's a void, there's a lack of information, and there's significant mispricing. So we hope all these things that we do, all the different due diligence levels of the different areas that are critical to make an investment work, that's what we try to bring to our subscribers.
Good, thank you. So when you think about attrition and you think about keeping the newsletter interesting, what are some of the things, Paul, maybe we start with you again, that you feel are good? Is it guest writers? Is it just pure track record? What are the types of things that keep folks interested and engaged?
I mean, ultimately, it's track record. If you don't have a good track record, I don't think you can do anything that's going to keep your subscribers interested. One of the things we've done, we've actually taken a bit of a community approach. So we have a forum that opens up the ability for our subscribers to ask us anything, or to, in some cases, they actually bring some of the due diligence or some of the research to us. So that platform has been quite popular amongst our subscribers. We, again, because we're investors first, we don't, we're not out there delivering a new name or a new idea every 2 weeks or every 4 weeks. We will only put something out if we see it's material and it's something that is significantly or offers a significant opportunity. So I think our subscribers have come to appreciate that we don't just put out information for the sake of putting it out. It's going to be something material. And like I said, we try to engage the community so they're involved and get maximum benefit from what we do.
Maj, how about yourself?
Yeah, that's a good question, man, because we deal with this all the time. And how do you keep your subscribers happy? And there's a whole different. A lot of investors have different goals. So we basically, when we were doing our research to find out how to kind of structure our offering, we found out 60% of the investors, when they were, we didn't survey, we were referencing reports, just want a stock pick. The remainder either want education or research tools. Education was about 30%, and I think 10% was research tools. So it surprised us a little bit because we thought, because we're. So what we decided to do is we do a little of everything. We try to we educate by writing educational material, and to keep that portion of the community happy. We definitely offer a lot of call to action type of kind of picks. For a wide variety of type of strategies, though. There'll be long-term multi-bagger type of strategies, the growth and value, the short-term information arbitrage we call it, which is basically taking a very quick, exploiting a very quick opportunity in a misunderstood story or situation. So so we try and keep it very broad, and what we really try and do a lot of, we try and attract the investor that does want to do research, because we basically are always doing diligence and always reporting to our community what the diligence we're doing very early in the process, so they continue to, they can do their own research too, so that saves time. So we try to make our subscribers money, save them time in doing research and educating. And the first thing, when I meet a subscriber, face to face, they're like, well, first, you're crazy for giving this information early in the due diligence process before you're doing anything with it. And how are you able to find time to give us all this research? So, and that's the kind of feedback I get.
That's good. That's good feedback.
Yeah.
Brett?
I think certainly making money for your subscribers is the best way to keep them. In our letter, we've consistently beat the index against it, which we mark ourselves against, the GDXJ, sometimes by a fair bit. What's unique in what we try and do, what we study, is that earnings, for the most part, don't exist in these companies. They all spend money. They're exploring for a gold deposit or whatever. So it all comes down to, really, I would say 80% comes down to the science behind geology. What are they finding? What are they looking for? And what do we need to see to keep our interest and keep our investment in there? Our ultimate goal is a takeout, where someone makes a discovery and another company acquires it. And that just happened this morning to one of our companies, Mariana Resources, which we bought just over a year ago. It's a 300% gain. And I'll give you an example, if I can, of how we came in to buy this stock. It's a company exploring for copper and gold in Turkey, way northeast Turkey, in joint venture with a Turkish conglomerate. Their first drill hole into this project was amazing. It was a fantastic drill hole. The stock jumped some. We didn't buy at that point because our concern was, if I can do some real geology here, is that the drill hole went right down the mineralized structure, so that what looks like a 160-meter interval could have, in fact, been a 20-meter interval. So we waited until they came and drilled across this structure to confirm the width. And the width was confirmed, and we bought a lot at that point. And we stayed with it. I went and visited it immediately thereafter, and Joe was there about 6 months ago. And I think that's the second thing we bring to this that is you can't get out of the data. or out of the whatever's published on CDAR or the company reports and such, is we made 33 site visits last year, 2 projects, examining them. And once you get on the ground and look at these things and start to understand the concept behind what a company is looking for, then you can put the drill holes and all the data into perspective and make some decision whether this is going to be an economic deposit or not, and what they need to show us to stay invested or invest more into these companies. So that's kind of, in general, how the newsletter works. And our goal is we give a quick, buy, sell, hold, whatever, paragraph. But then we go into the details, because I find that at least half of our subscribers, they're interested in geology and want to learn about what's going on, because they can apply it to other companies they're looking at that we aren't covering. I think that covers what I want to cover.
It does, but if I didn't know to go to CDAR, it's primed to come to your newsletter, right? As an investor, I'm not going to go make a site visit 30 times to discover these things, right? That's the value in some of this.
And the problem with a lot of stuff on CDAR is it's
Difficult to get to?
No, it's easy to get to, but it's all put out with a promotional bent.
Yep, fair. Each of you focus on specific aspects of the microcap space. What do you see that's going on in each of your focuses? Is there something transformative going on? Is there an economic change that has you concerned? Is there something you're super excited about? As you start to think through the companies you're covering, and maybe use a couple of companies as examples, as we talked about earlier.
I think right now we're in a really interesting period in the minerals exploration and mining game, particularly in terms of gold. We are mining about 90 million ounces of gold a year, the industry as a whole, and last year we found about 40 million ounces. This has been going on for over 10 years now, so there's a real deficit in new discoveries, new deposits, economic deposits for the majors to replace what they're mining. Every ounce of gold you mine, if you don't replace it, you're going out of business. So I'm really keen on what we're seeing now is that the discoveries are really, really hard to make, and the few that come in that work are going to be acquired at a major premium by the larger mining companies as their reserves get less and less. So I can see that that's happening definitely in gold. It's starting to happen in copper. Zinc, we've got a deficit. That's where we're focusing on. And I think the long-term game plan here is that these major mining companies are going to have to buy legitimate economic deposits. And that's our focus.
Maj, U.S. microcaps, what's going on there for you? And what
Well,
are you
first,
passionate about?
first, I guess I can talk about what has happened before, up until now, and from my experience, at least, investing in the space for a long time, over around 30 years or so, is that after 2008, we know the retail investor, was significantly reduced. It used to be a great driver of value for the microcap sector, like the first leg before the institutions would get there. And then also what happened was that there was an aversion to being in stocks for a long period of time. So the holding period of investors really came down. Pre-2008, at one point, it was up to 5.5, 6 years was the average hold time for a retail investor. Now, I was just reading this article. It's several weeks maybe, or several months at most.
Yep.
So that tells you a lot. And what seemed to happen was that I think that there was an aversion to risk. So the aversion to risk makes investors almost speculate more, though, when the next hot thing the next biotech or the next thing that's going to happen fast. So what happened over this time frame is, I'm speculating at least, and from my experience, is that the growth and value proposition, although it works, but it worked a lot better, before 2000, and your return was catalyzed a lot sooner. So and then you have the issue of more passive investments. Taking on BlackRock now is basically focusing more on passive investing. So that's what's kind of the environment that's been set. But there's always a reversion to the mean, and then there's a pendulum is going to swing. I remember in 1999 they were talking about microcaps being dead. And so this conversation comes up at times, and there's going to be a reversion to the mean, and that's happening. Whatever your political affiliation is setting aside, since Trump was elected, there's been some kind of resurgence in the small cap, microcap arena. And I've noticed that from the investors I've talked to in my community, that I got young investors, so they're holding a little longer. Stock picking is getting a little better. Bids are in these stocks now, so the environment's getting better. And I actually think that the fact that there is more passive investing going on is going to create a lot of opportunity and efficiencies in the microcap sector and small cap sectors, and eventually that's going to be noticed, and the panel's going to come back to stock picking again, and this is happening. But the one thing that's very interesting is M&A and activists. Okay,
Yep.
so activists are coming down the food chain. Fortune just wrote an article about this last year, that they basically exploited a lot of what they can in the bigger cap companies, and now it's all about finding edges. And they're starting to come down the food chain, the microcap companies, and find these companies with either bad corporate governances or maybe old management teams that need to be revived, and they're finding opportunity, and that's going to restore some balance too.
Just to follow up on what Maj is saying, we as a company, and not to get on my soapbox about what we do, but we work with about 2,100 public and private companies globally. And Maj's point is absolutely consistent with what we've seen in the last 12 months in the market, is you get very passive individuals that pick up 1% to 2% of a company and quickly emerge to 8 and 9 and 10% and become that activist. And some of these microcap companies don't understand how to deal with that. So if that's something that you're calling out, that's of significant value to all of us making investments. Is we're blind to some of these things sometimes. You just think that they're passionate about the company, or they know management and they believe in management, and sometimes there's completely different views there that you should be aware of.
Yeah. We're constantly, looking 13D filings, purpose of transactions, and they're really talking to activists too to see what's going on in the field too. So.
Yep, absolutely agree. Yeah, Paul, maybe the same question, but if we expand upon it, I'd like to maybe delineate a difference of subscribers, if we could, if you know the numbers of Canadian newsletter subscribers to U.S. And do you, if you've got something going on in the newsletter that and the market, as the question we were talking about, is there a difference between the two, or do you tend to just do them as one?
Well, we see about a 50-50 split in terms of Canadian and international subscribers, and of the international subscribers, I'd say predominantly they're U.S. What we've found is, there's a real shift about 4 or 5 years ago where we're starting to see a lot more U.S. investors taking an interest in the Canadian market, specifically in the non-resource side. I think we're continuing to see that. I think there's been more and more interest, and I'm not 100% sure why that is, but a lot of U.S. investors, and I see a lot of them around here that I know are big fans of Canadian companies. I don't know exactly why that's happening, but it's a phenomenon that it continues. I think some of it is that there's a higher level of sophistication in general with U.S. investors, and they're prepared to do more due diligence on some of these small companies than what I've seen in Canada for years. There's a little bit more reliance on Canadian investors, that they're looking for institutional research or somebody to cover a company before they get involved, or non-Canadian investors are prepared to just dig a little deeper and go down further. So that's something I'm noticing. In general, though, what I've found is, especially over the last sort of 6 to 12 months, is that we've almost run out of stories up in Canada. I think because there's been such a strong interest, a lot of the companies we're finding are sort of fairly valued. A year or so ago, or 4 years ago, we're finding bunches of companies that met our criteria. Where now, we might be lucky if we see one every 3 or 4 months. So I think it's an influx of non-Canadian investors that's driven some of that. One of the things we're doing for our subscribers on that end is that because we're not finding as many good ideas on the public side, we're fortunate that we actually have pipelines of companies that are private, that are interested in going public, and we're actually finding better values in that market than we are in existing public companies. So, we tend to move around a lot. We tend to kind of use that information I just told you about as far as the valuations or the scarcity of good valued companies right now. To us, that's a bit of a canary in the coal mine. That you tend to see that closer to the end of a bull market than the beginning of a bull market. So those are little signs that we look for. I mean, ultimately, if we find a cheap company that meets our metric, it doesn't matter what we think the market's going to do. That's what drives our decision. But those are sort of the influences we're seeing right now.
Good, thank you. Perhaps it's obvious to some of us, and definitely to you guys. Is there an overvalued area of the market? Is it overbought? Is there a category or a sector you're staying clear of? And are you talking about that in your newsletters? Or is there something you're seeing that you're going to be talking about? Any one of you can go.
I know from our perspective, we're total bottom up. So we're not really sector driven, and we don't really try and time markets or time sectors. We avoid sectors that we don't understand or that are unpredictable to us, more unpredictable. So we tend to stay away from them unless it's a very special situation. But I think there's always opportunity to find value in any market, and if you do enough research, and the amount of those opportunities can shift over time. But it just depends how hard you're looking, I think, is what we look at it. So, we just are company specific. We look for companies, and we let the companies tell us what sectors are hot or what aren't hot, and we decide if we want to be involved in it.
It's a good way to do it. Brad or Paul?
One of the philosophies we use is what we call the discovery process. We try to stay away from companies that are well known or discussed a lot. Part of our research is we comb through the different social media feeds, and we look for how many times a company's been mentioned, or how many people know about it, or if it's talked on CNBC or BNN up in Canada. Those are indicators for us if something is a little bit too exposed. We like to go the opposite end, where we want to find companies where we've got almost no competition on the buy side, and nobody knows about this company and nobody's talking about it. So as far as sectors, up in Canada, the cannabis market, that's been all the rage. It's been all over the media. That's a sector we stay away from, partly because the fundamentals don't make sense to us. But the other part is the exposure it's getting. That's one thing I advise investors is if you really want to maximize your returns, you got to go where nobody's going, and so that's how we look for that.
I'd say we tend to avoid the metals that aren't readily traded on London's metal exchange and such. Products like lithium, graphite, rare earths, etc. There's always some metal that's hot sector, and would be it lithium or graphite. But the problem with those things is it's all about marketing and the offtake and the quality of that product. You've got to sell it to a company that's going to use that. And so we tend to avoid that and just stick with the major metals: copper, gold, silver, lead, zinc, nickel, uranium, that sort of thing. That's who we know. We know Rio Tinto or Newmont is going to buy an asset, and that is our exit strategy usually.
Good. So everybody has the blueprint of identifying, right, and analyzing and being disciplined in a company and making an investment. Are there behaviors or indicators? And I know you guys have talked about some of this already, but maybe we expand upon it a little bit that you attribute to the modeling in some of your newsletters and research.
I'm not sure what you're asking. Sorry.
So if you think about all of maybe Maj, we'll go look at Maj, right? If we look at all the companies that you that go through and identify and do all your analysis, what are the indicators of risk that you say, I'm going to make a jump on this one because I believe in this company? Is there something there? Is it just management, right? You talked a little bit about this, but you maybe didn't touch on management. Is it the hot sectors, not cannabis? What is that?
Well, we're continuously looking for catalysts and inflection points, is the thing, and I guess I think I mentioned earlier is that we're looking for situations where the growth, there are improvements in the growth and the risk profile of the company. So what those might be, and then if they happen together, that's great, and hopefully you get expansion in PE multiples. So some of the things we're looking at, are margins. We're looking, for example, when our margins are going to increase, but not necessarily. How long are they going to increase for? Is it going to be a long runway of improvement in the margin cycle? And not even the level of margin, it's where they're going to go. Warren Buffett said something in one of his interviews that he'll invest in low margin businesses as long as there's a high return on tangible assets. So it's about where relative they're going to go. We're looking for companies that make acquisitions and where this acquisitions seem very smart, but the market hasn't valued it on the combined company. We're looking for boring companies that have been around for years, that haven't been growing, but they have sales and earnings, that they're going to become beautiful again. And these are things we try. Very easy, simple stuff. But one of our most favorite things to do is to find such companies where the risk profile is going to change. And the reason being is because some of these companies seem like the hardest to analyze.
Yep.
So when you take a situation where you have a seemingly complex story, but that's actually simple when you dig deep, but it's going to scare some investors off. So it gives you a chance to get in there and build positions in stocks now where maybe in 2 or 3 quarters that's going to look really cheap, and it's one of the great things we love doing. And
companies are making a pivot too, right? That no one else has discovered, right?
No one's discovered. No one's discovered. And the thing is, no one's discovered. It's all about where the price is right now. We're looking at the value. We don't care if people know what the stock. If it's undervalued, people don't know it's undervalued.
Sure.
That's how we look at it. And so there's a lot of recycling of these stocks going on in the market over time. And it's and it can happen at any point. And management's so key in this whole thing, though. Because you can find catalysts, and these catalysts can be short term, but if you don't have a great management team to carry these catalysts long term, that's an issue also. And in the end, that's probably the most important thing, the long-term investing. So as an investor, though, a full-time investor, having to live off the income, we have to always have a balance of the short-term catalyst driving some income towards the long-term, hopefully multi-baggers that build wealth over time.
Paul, what about you? What's in your model that gives you the edge?
We take the approach that we're not that smart, right? So we try to keep things as simple as we can. And what we're really looking for is in the data that we're going through is we're looking for trends. If you see earnings have been growing by 25% a year for the last 4, 5, 6 quarters, chances are that trend's going to continue. So we're constantly looking for growth trends, obviously profit trends, margin trends, things like that don't have. It doesn't require us to be educated in things that we just don't know. Is that product sellable? Well, if they're selling it, that answers our question. Is their technology better than somebody else's? Well, their margins are expanding. That's likely to tell us that that's the case. So we're constantly looking for trends within our data points to help us to analyze. And we think that the fundamentals or the financials will probably tell you 90% of what you need to know about any business. Are management good? Well, again, if all those trend points are going in the right direction, it's a good chance that management know what they're doing. So it's, again, we try to simplify it. If you can identify companies that have trends going in the right direction, you got a good chance of success.
Brent, come back to you.
Yeah, real quickly, I could go into a lot on this. Is screens. There's about 1,500 junior mining exploration companies listed globally, and you need to screen through those as quickly as possible. And the simplest one is, does the concept that the geologic team is throwing at you, the management team is throwing at you, does it actually make sense? We find that over probably 60, 70% of the companies with a mineral property, their concept doesn't work, and even if they're successful, the impact on the share price is not worth the risk of doing it. So it comes down to screens: management screen, property screen, and are they financially capable of raising additional funds at higher prices, assuming their concept holds together. So that's really what we do spend a lot of time on.
Good, thank you. Could ask a bunch more questions, and I may put you all to sleep. So rather than doing that, why don't we get into some Q&A? If anybody has any questions, we'd like to ask the panel. Yes, sir.
Brent, how you doing? My name is Chris Irons. I work with Maj Soueidan. I just have a question for you about using the GDXJ as a comp. Given the enormous weighting change that's happening with GDXJ over the last, I don't know however long it's been, last quarter or two, they've been in there buying a ton because there's been this massive inflow into the ETF, so they have to allocate capital somewhere. I guess kind of a two-part question. One is I kind of want your thoughts just on the new revised weighting of the GDXJ and whether or not you think it's still a decent way to get exposure to junior miners. And then my second question is, because you deal in so many metals, it sounds like, why measure yourself just against the GDXJ, which is primarily just a gold mine?
So I've got to repeat that, Brett, just for the folks on the audio file. So GDXK is a barometer as he's using, and some of the rule changes. Maybe we'll touch that one first.
Yeah, that's a real problem, and we dealt with it just in last week's newsletter. Joe went into it in a lot of detail. The changes that are happening in the GDXJ, it used to be more focused on the smaller mining companies, but now they're bringing in much larger mining companies. So its usefulness to us as a comp, it just doesn't work. And what we have been doing, actually, and to your second point, is if we own a copper stock, we base that against a comp in that sector. So we break it down from that. The GDXJ worked for the gold companies. I don't know what we're going to use instead right now to compare ourselves against. I know Sprott has something, and there's a few others we're looking at. But it's a problem, and I don't know how to fix that. And
is there so much of a deviation between the price of, whatever the front month gold futures are and miners? Is there so much of a deviation between the two that you can't just use the front month gold futures?
A deviation between which two?
Well, I'm just asking if you have a gold-specific company, right? Is there too much deviation between the price of the actual gold future and the mining companies, which move with the price of gold, but also have other bits and pieces and moving parts to them?
that may work for the larger companies like Newmont, Barrick, and such, assuming they don't have some disaster. They do follow it. But when you're dealing in the sector that we're dealing with, which is sub 100 million market cap companies, a lot of them are even a lot less than that, there's no index that really works for it because it all comes down to, did they make a discovery or did they fail? So it's tough. That's the best we can do, I'm afraid. But actually, send me an email, and I will send you this last week's letter where we went into that. In fact, anyone's welcome to that.
Yes, sir.
So right now the government's discussing lowering tax rates on corporations. For small companies, do you see that if they are successful in passing this, this will be a huge opportunity in the MicroCap space as far as paying lower taxes going into the future?
So the question is about the current Trump plan talking about tax reduction for small microcap companies, but in most parts, many corporations.
Right. Well, I think that anything that is going to increase the profits of a company is going to help its valuation, and bring some euphoria, short-term, or at least near-term euphoria, to a lot of companies. Ultimately, what will happen to the valuations of these companies will be how that translates into economic expansion or lack of expansion. So, but yeah, I think it's going to definitely be good for companies, and it might be we might get a nice little lift in some valuation of a lot of these small companies for sure.
Further thoughts, guys, on that question?
Well, we deal in Canadian companies, so we're less affected by that. But we don't. A lot of the companies we invest in are very niche-y or involved in niche markets, so they're more affected by what's going on within that sector than they are by tax rates or a lot of other economic, changes. So, I think if you're a real true bottoms-up approach investor, you got to look a little bit away from those sort of industry changes because so many other factors are more important.
Actually, as an add-on to that question, I noticed some of the Canadian companies drive almost all of their business to the United States. Do you see that if there is a shift in corporate tax rates, that there will be a repatriation? In fact, the companies will withdraw from the Toronto Exchange and just incorporate in the United States and list on the U.S. exchange?
So the follow-up question has to do with Canadian companies and the influence that they've got from the U.S. markets.
Yeah, we're seeing a lot of sort of strategy changes where actually the one that's driving more decisions in Canada have to do more with the Buy America strategy. So if companies are building products in Canada and selling into the U.S., now they're starting to look at putting facilities down in the U.S. I think that's a bigger implication. As far as Canadian companies moving all their facilities down the States or their headquarters, I'm not hearing too much of that. But we've seen, and we've invested in a lot of companies that are U.S. domiciled that have their listing up in Canada. I don't think tax-wise there's much of effect on that, so I don't see much change there.
Additional questions? Yes, sir.
We've noticed as publishers of MicroCap Review that many of our subscribers have an increased interest in Canadian securities, particularly technology, which really kind of took us all by surprise back in LA. And I think part two of with that question is for Brent, and that is, do you notice an increased interest in U.S. investors in let's say, junior mining stocks over the course of the last, increase in the underlying commodities?
So Shelley's question really is, I think, part of what he's seeing as an indicator, and maybe to you guys as well, is you're seeing a resurgence or an interest in which now, Shelley?
Canadian securities.
Canadian securities.
Technology stocks.
Okay.
Well,
Technology stocks.
I'll take the first part. I think one of the big reasons why a lot of investors came up to Canada, several years ago, is the huge disparity between the valuation metrics in Canadian companies, specifically non-resource companies, to their comparables in the U.S. I mean, we're still seeing that to some degree, but that sort of discount has shrunk quite a bit. And also there's a scarcity of non-resource companies in Canada, especially profitable growing companies. So once they met a certain market cap, you'd see this big influx of buyers from everywhere, whether it's institutional up in Canada or U.S. So we definitely saw that.
Yeah, in terms of the mining sector, we haven't seen a big increase in retail U.S. subscribers. There's been a bit, but what's been interesting is we've seen a lot more coming out of Europe and Asia coming into our newsletter, and also a few more funds, bankers, and actual mining companies. So it seems to be shifting that way.
Maj, anything that you're seeing there?
I just know from our perspective, we get almost a couple of questions every week. When are you going to start covering more Canada stocks in your? And that's usually, and that's a lot of there's a lot of MicroCap investors in Canada, and I think that there's opportunity for them potentially to invest here. Maybe because what you're talking about is they see the valuations increasing in Canada, maybe here.
So I think Gio's now obligated to cover some Canadian companies.
Yes.
Right?
Yeah, we'll be doing that in the next few months.
So also, one of the things that was touched on in the panel before you was cross-border acquisitions of Canadian companies by U.S. domiciled, listed, and non-listed companies in the U.S. Do you have a comment on that?
So cross-border acquisitions from U.S. companies domiciled here, buying upstream in Canada?
We've been seeing that for years. You guys are the big brother, and we're the small guy. And once a company gets some success in Canada, that's one of the exit strategies, is to find a larger company to buy them, and predominantly it's U.S. companies doing that. Again, it probably has a lot to do with the value discounts that we're seeing in Canada. So we're seeing acquisitions on a regular basis, and we've been seeing that for years.
So potential tax savings, right, could be an impact to this, right? As some of these microcap companies could see a benefit to some of that. There could be a little more activity there, perhaps.
Yeah. Keep in mind there's like a 30% plus discount in currency, so that Canada's for sale right now.
Yes, sir.
This question is more for Brent and Maj, of course, they know the answer and follow it up. What strategies have you guys found effective for growing your subscriber base over the years?
It's a good question, right? It's what have you found that, what is your strategy for growth of your subscriber base?
Well, no, it's always a interesting. It's a moving target for us. I mean, sometimes it's there's the camp that tells you got to be sensational, give out these picks and.
But wait, aren't you?
Well, yeah, we do. But the way it's the way you present it. We don't want to present it like in a fashion to it seems sensational. So. We find that we're more quality driven in the way we display we present our message. We get a better quality subscriber, and that's what we're looking for in the end, is a better quality subscriber. We're not, so we could definitely step it up, and when we are more promotional, we do get a little more runway, but that's not what we want. So we're happy with the way we're doing it now. Is we're looking at it as how can we get quality investors into our funnel, because they provide a lot of ideas to us also, and that's what we want. We want an investor that appreciates what the quality we're going to give them, and where the attrition will be less. So that's how we kind of look at it, and that's more. But when we are more sensational, we do get interesting responses here and there. But I think when you tailor your message to a certain group, that group starts to understand what you're doing, and you get really good response from that group.
Yeah, we tend to follow a stealth strategy. Basically coming to shows like this, appearing on television shows, and that sort of thing. Most of the people, new subscribers we get, I'd say half, is word of mouth. And like Maj was saying, I think you get much better long-term subscribers that way than putting out a sensational piece where buy this stock you'll make 300% over 2 weeks. Those people don't stick around, and they tend to be more of a hassle than they're worth. Mm-hmm. So it's just mostly word of mouth and getting out there and talking at events like this.
Yeah, I have to agree. When these events are great for us too. I mean, and that's definitely, you start meeting people, they start, understanding the vision, and that's where we get a lot of our runway also.
I would imagine that events and conferences like this and word of mouth is the best way to get a subscriber, right? The cost of acquiring that subscriber is, infinitely smaller. Is there other ways? Social media? Is there other things?
Yeah, we use social media. You can use email marketing campaigns, but I find, for the ROI, something like this is a lot better. Yeah. And then, the more we concentrate on marketing, the more it takes away from what we do best. It's research, finding great companies, and these kind of things. And there's something to be said about that also. So you want to also treat your current subscriber base with the right attention too. And so there's always so much time in the day to do certain things and resources to deploy.
I can't see you behind an email, right? So coming to an event like this for investors is getting an opportunity to see you folks, I think is a good thing. We have last questions, or we've got time is up. Usually I'm early in this. Bobby, come on. Guys, I appreciate it very much. Give these guys a round of applause.